Your credit score is one of the most important numbers in your entire financial life. It quietly affects the interest rates you get, the loans you qualify for, and sometimes even whether you get approved at all. Many Americans work hard, earn decent money, and still struggle financially simply because they don't understand how credit scores actually work. In this video, we're going to explain credit scores in the United States in the simplest way possible, step by step, from the basics to real-world examples. A credit score is a number used by lenders to estimate how risky it is to lend you money. In simple terms, it answers one question: how likely is this person to pay the money back on time? In the United States, the most commonly used credit scoring system is the FICO score. A FICO score usually ranges from 300 to 850. The closer your score is to 850, the more trustworthy you appear to lenders. Lenders don't know you personally. They don't know if you are responsible, careful, or reliable. So instead, they rely on your past behavior with credit. Your credit score is basically a summary of how you've handled borrowed money in the past. If you've paid on time consistently, your score improves. If you've missed payments or defaulted, your score drops. One thing that confuses many Americans is the difference between a credit score and a credit report. These two things are related, but they are not the same. Your credit report is a detailed record of your credit history. It lists your accounts, balances, payment history, and any negative marks. Your credit score, on the other hand, is a summary number created from that report. Lenders usually look at the score first, but the report explains why the score is what it is. This is important because fixing errors on your credit report can sometimes improve your score. You don't fix a score directly. You fix the information behind it. Now let's talk about your credit score on different apps. Many people panic when they see different credit scores on different apps and websites. This is actually very common and usually nothing to worry about. There are multiple versions of credit scoring models. Some apps show educational scores, while lenders may use slightly different versions. The important thing is not the exact number, but the overall range and direction. If your scores are generally improving, you're on the right path. Small differences between platforms are normal and expected in the US credit system. Here's something that surprises many people. Sometimes, paying off debt can cause a small, temporary drop in your credit score. This doesn't mean you did something wrong. It usually happens because your credit mix or account structure changed. The key word here is temporary. Over time, paying off debt is always better for your financial health. Short-term score changes matter much less than long-term habits. Your credit score is used by far more people than most Americans realize. Banks use it when you apply for loans. Credit card companies use it to approve or reject applications. Auto lenders use it when you finance a car. Mortgage lenders use it when you apply for a home loan. In some cases, landlords may check your credit. Insurance companies may consider credit-based data. Even utility companies sometimes review it. This single number plays a role in many major life decisions. Credit scores are usually divided into ranges. A score below 580 is considered poor. Between 580 and 669 is fair. Between 670 and 739 is good. 740 and above is very good to excellent. Higher scores usually mean lower interest rates and better approval chances. Lower scores mean higher costs and more restrictions. A higher credit score can save you a lot of money. Lower interest rates mean smaller monthly payments. Smaller payments mean more money stays in your pocket. A lower score often leads to higher interest rates. Over time, this can cost you thousands, sometimes tens of thousands of dollars. Two people can borrow the same amount of money and end up paying very different totals simply because of their credit score. Your FICO score is calculated using 5 main factors: payment history, credit utilization, length of credit history, credit mix, and new credit. Each factor has a different level of importance, and understanding them gives you control over your score. Payment history makes up about 35% of your credit score. This factor tracks whether you pay your bills on time. On-time payments help your score. Late payments hurt your score. Missed payments hurt even more. A single missed payment can stay on your credit report for up to 7 years. This is why paying on time is the single most important habit for good credit. Credit utilization makes up about 30% of your score. It measures how much of your available credit you are using. For example, if your total credit limit is $10,000 and you are using $3,000, your utilization is 30%. Lower utilization is better. Most experts recommend keeping utilization below 30%, and ideally below 10%. Length of credit history makes up about 15% of your credit score. This factor looks at how long you've been using credit. Older accounts help your score because they show long-term responsibility. This is why closing old credit cards can sometimes lower your score, even if you don't use them often. Credit mix makes up about 10% of your score. This refers to the variety of credit accounts you have. Examples include credit cards, auto loans, student loans, and mortgages. Having different types of credit shows lenders you can manage multiple obligations. New credit accounts for the final 10% of your score. Every time you apply for credit, a hard inquiry is added to your report. Too many inquiries in a short period can temporarily lower your score. This signals potential financial stress to lenders. Imagine two people applying for the same loan. One person has a credit score of 620. The other has a credit score of 750. The person with the higher score qualifies for a much lower interest rate. Over a 5-year loan, the lower score borrower may end up paying several $1,000s more. This difference comes purely from credit score. Many people believe checking their credit score lowers it. This is false. Checking your own credit is a soft inquiry and does not affect your score. Another myth is that carrying a balance helps your credit. In reality, paying balances off is usually better. Addition to this, many people believe that credit scores change only once or twice a year, but that's not true. In the United States, your credit score can update every single month. Anytime a lender reports new information, your score can move. This means one good month can help you, and one bad month can hurt you. That's why consistency matters more than doing one big thing. Improving your credit score takes time, but it is possible. Pay all bills on time. Keep credit card balances low. Avoid applying for unnecessary credit. Review your credit report regularly for errors. Consistency matters more than perfection. Your credit score is not permanent. It changes based on your financial behavior. Once you understand how it works, you gain control over your financial future. One important thing many Americans don't realize is that credit scores are not fixed. Your score can go up or down every month depending on your actions. Even small habits, like paying one bill late or using too much of your credit limit, can make a noticeable difference. The good news is that positive habits compound over time. Consistency matters more than perfection. It's also important to understand what credit scores do not measure. Credit scores do not measure how hard you work. They do not measure how much you earn. And they do not measure how smart you are. They only measure how you handle borrowed money. Once you understand this, credit becomes a tool instead of a mystery. Credit scores can cause a lot of stress and anxiety. Many people feel judged by a number they don't fully understand. But a credit score is not a measure of your worth. It's just a snapshot of financial behavior over time. The good news is that behavior can change. And when behavior changes, scores eventually follow. Understanding how credit works removes fear and replaces it with control. In the next video, we'll break down the biggest mistakes that quietly destroy credit scores and how to avoid them.